The stock market is currently closed, so let us look at the definitive numbers from the latest session. NVIDIA stock officially closed at $202.81 per share, marking an intraday decline of 2.21% as the broader technology landscape experienced a sharp semiconductor sector rotation. While retail investors are staring at that daily decline with anxiety, the actual narrative driving institutional order flow behind the scenes is not a sudden collapse in artificial intelligence demand, but a profound structural shift in how hyperscalers handle their free cash flow compression. Everyone looking at a simple stock chart assumes this pullback is just typical market exhaustion after an unprecedented run. Yet the reality points toward a massive structural recalibration where cloud service providers are driving up capital expenditures to absolute extremes, forcing a short-term liquidity squeeze across the chip supply chain, even as the underlying hardware demand remains completely insatiable. The common ground shared by the vast majority of retail participants on popular investing sites is that this company has become an unstoppable monopoly, a permanent structural winner that you can blindly buy whenever it dips. People open up their individual brokerage accounts or check their Robinhood app allocations, assuming that the transition from gaming graphics to multi-trillion-dollar data centers guarantees an endless upward trajectory. But the reality you must confront is far more complex than that superficial viewpoint. When you execute an online investment or manage a self-investing strategy, you have to look past the general hype and dissect the massive structural tension between what the consensus expects and what the operational numbers are actually delivering. Right now, the market is pricing in absolute perfection, yet institutional allocators utilizing advanced interactive brokers trading platforms are closely watching the growing margin compression warning signs coming out of global foundry partners. It is no longer just about whether tech giants want more hardware, it is about whether the global supply chain can physically and financially sustain the sheer pace of this massive build-out without crushing near-term corporate returns. When analyzing the recent stock movement, the daily swings tell a fascinating story of a tug-of-war between retail optimism and institutional hedging. Over the last several trading sessions, trading volumes have surged well above their historical averages, indicating intense distribution as large-scale portfolio managers rebalance their tech exposure. The recent earnings reactions across the broader technology ecosystem have acted as a double-edged sword for NVIDIA stock. On one hand, you have massive foundational demand, but on the other, you have a paradox where stellar earnings from partners drop hints of rising input costs, sending shockwaves through the semiconductor market. Sector momentum has turned highly volatile, influenced by macroeconomic pressures, including persistent global monetary adjustments and sudden geopolitical risks that threaten to complicate cross-border shipping lanes. Institutional activity shows that large mutual funds and exchange-traded funds are quietly adjusting their weightings, moving away from hyper-concentrated long positions to manage portfolio risk. Comment below how many shares of NVIDIA stock you currently hold in your portfolio right now. If you are managing your own capital through a Fidelity brokerage account or utilizing automated tools like Schwab Intelligent Portfolios, you need to understand exactly what this business model is built on to gauge where it goes next. At its core, the enterprise designs high-performance graphics processing units, central processing units, and complex networking solutions that act as the foundational computing layer for modern data centers, cloud infrastructure, and advanced software engineering. Looking back at older fiscal reports, the financial trajectory has been nothing short of extraordinary, moving from triple-digit top-line growth to generating tens of billions in pure net income within just a few sequential quarters. The corporate strategy has deliberately shifted from selling individual hardware components to providing complete integrated data center architectures, allowing them to capture massive hardware premiums while locking customers into a proprietary software ecosystem that makes switching to competitors incredibly difficult and expensive. Looking toward the future outlook, the ultimate trajectory for this asset will be determined by the severe tension between market expectations and operational reality. If the upcoming quarterly earnings cycles confirm that major hyperscalers are maintaining their massive capital expenditure commitments without showing signs of fatigue, the stock could easily break out toward new historical highs, validating the bullish long-term target prices set by major Wall Street firms. However, if the reality reveals that enterprise software adoption is lagging behind the massive hardware build-out, or if customer diversification efforts begin to erode pricing power, the current valuation could face a significant downward correction. For investors navigating these markets through online investing platforms or managing their assets via a dedicated Fidelity trading platform, success will require blocking out the daily noise and focusing entirely on these core structural catalysts. Ultimately, the reality of global infrastructure demand continues to battle against the incredibly high expectations embedded in the equity price, and tracking that specific balance will be the key to understanding where the market moves from here. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.